Ladies and gentlemen, good day and welcome to PDS Multinational Fashions Limited Q3 FY22 earnings conference call hosted by Centrum Broking Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shirish Pardeshi from Centrum Broking. Thank you, and over to you, sir.
Thank you, Nirav. Good evening, everyone. Thanks for taking out time. We have with us PDS management headed by Mr. Sanjay Jain, Group CEO. We also have joined by Mr. Ashish Gupta, Group CFO, and of course, Reena Joseph, Head Corporate Finance and M&A Investor Relations is also there on the call. We have an absolute pleasure hosting on behalf of Centrum Broking. We have a positive view on this unique platform model which has there, and in front of you, you have the presentation which is also showing up how the quarter looks like. So without any further delay, I will hand over to Mr. Sanjay Jain. Sir, over to you.
Thank you so much. A very good evening to all of you who have joined us today. We welcome you all to the third quarter and 9 months ended December 21 earnings call. First and foremost, we are happy to share that almost 2 months back we had set the ball rolling for simplifying our company name from PDS Multinational Fashions Limited to PDS Limited. We have received the requisite approvals from our board shareholders and the registrar of companies. This is effective January 28, 2022. So from now on, we would be known as PDS Limited, with global, collaborative, digital and ethical being our key fundamental pillars underlying of doing our business. In the 9 months ended for the fiscal 2022, 9 months ended December 21, PDS has reported a 36% growth with a top line of 6,053 crores versus 4,448 crores last year. We have reported EBITDA of 220 crores in the 9 months period with a 3.6% margin, and that is a 65% growth as compared to 133 crore EBITDA in the previous year. So in the 9 months, while the sales have grown 36%, the 5% over the same 9 month period last year. The profit after tax have increased 162% in the 9 months period, with 207 crore achieved this year in the 9 months versus 79 crore achieved in the 9 month period last year. The PAT margins have expanded from 1.8% last year to 3.4% this year. We are pleased to share that in the 9 months period, we have nearly achieved our full year numbers of last fiscal, and we are on track to reach $1 billion top line in FY22. With what we have achieved in the 9 months and the order book that we have for the quarter 4 gives us confidence that we should be able to surpass the 1 billion top line in FY22. Touching upon the key highlights for the third quarter of this financial year. In this quarter, we reported a top line of 2,232 crores with a 37% growth over last year. We continue to report our strongest quarterly performance in the last 5 years in terms of top line along with operating and PAT margins. This quarter, our profit before tax increased with a 37% growth to 85 crore as compared to 62 crore last year. Now that was for the company on the whole for 9 months and 3 months period. Now if I move to our sourcing business, which accounts for 96% of our top line, that business has grown 34% in the 9 months period up to December 21 with a top line of 5,807 crore. and our sourcing business with an EBIT of 213 crore reported a return on capital employed of 51%. Over the last few months, we have been talking about expanding into new categories, new geographies by not only hiring, but also setting up new teams with strong industry experts. These investments, which are basically the initial setup costs and funding support that these businesses need till they become cash break-even, are actually part of our operating expenditure. Allow me to clarify once again that in a typical model, when one is investing for growth, it would be a capex going into the balance sheet. But for us, when we look at new categories and geographies, we set up new verticals, and the entire funding that is provided is actually going out as an expense. So what we have reported to you as the segmental results for sourcing business and also for the company on the whole, is actually expensing of the investment we have made. If we do a like-to-like comparison of our existing business, excluding the new setups, then the EBITDA margin have actually increased by 48 basis points, in the quarter. And I also want to add that what is the potential of these, investments or expenses that we are incurring? They would start generating return in terms of surplus generation on an average from 18 months onwards, and typically in about 3 years from the date of the initial investment, that they come to their full potential of top line as well as the PBT generation. In fact, we have invested close to $3 million in the 9 months period. That's approximately 23 crores. And the potential of this 3 million investment that we have made, is that in about 3 years from now, we would have succeeded in our endeavor to add home as a category, to add accessories as category that we're offering to our existing customers, to further augment the fast fashion, and further increase our presence in the US market, which is witnessed in the results that we have reported to you and also captured in the investor release. And somewhere we believe from this 3 million investment that has happened, and we'll probably have another 1.5 million to 2 million that we may invest over the next 1 year as we get closer to break even. There's a potential of $300 million annualized top line at the end of 3 years in terms of run rate and a PBT margin of 4% plus. And we believe from this investment, as they come to their full potential, the return on capital employed would be about 60%. That's correlating the investment we are making for the newer revenues that we are adding and the financial outlook that we expect from these investments. And if we, as I mentioned earlier, if I exclude these investments, then there is close to a 48 basis point improvement in the EBITDA margin. Further, we are seeing a shift in the way brands and retailers are currently, operating. They are more inclined to focus on customer-facing operations and exploring outsourcing of their sourcing function. So they want to focus, as I said, on the core business of front end, and leave the sourcing part to third parties who can actually come forward and take this responsibility from their balance sheet. We have successfully tapped into these opportunities and are seeing good traction with leading brands and retailers. We're offering sourcing as a service to large brands and retailers who are exploring outsourcing options that are exclusive to pre-agreed territories. One such arrangement that was recently concluded was by our Germany-based subsidiary Techno Design that signed an exclusive agreement with a leading German brand S. Oliver. As part of this arrangement, Techno Design shall have exclusive sourcing rights from India and Sri Lanka for the S. Oliver Group. And this sourcing arrangement was signed through acquiring their associate company in India. The integration with PDS platform has been largely completed, and this partnership has potential to translate into annualized revenue of about $50 million, which is close to about 375 crore sourcing opportunity for one retail customer originating from Germany. And we are also, secondly, further happy that we have entered into an arrangement with Hanes Brands of US under which PDS will operate as a sole and exclusive vendor for Bangladesh. And further, PDS can also source merchandise for Hanes from its factory network in Pakistan, Egypt, India on a non-exclusive basis. So there is exclusivity for Bangladesh, and there are other geographies where we can source for Hanes on a non-exclusive basis. We have created an exclusive team along with an independent office infrastructure in Bangladesh to provide services under this contract. This arrangement, I mentioned about $50 million from the olive arrangement as an annualized potential to earn as we scale up. This arrangement with Hanes has a potential to translate into 400 million opportunity over 5 years. Similar to this setup, we are carefully taking this forward and are in good state of discussion with leading brand retailers in our key markets. On another note, our momentum of expanding our footprint to North America continues to be strong. We had ended the last financial year with North America contributing close to 8% of our top line, and 9 months into this year, we are currently at 19% of our top line. In the third quarter, with year-to-date sales already clocking over 120 million from the North American market. The arrangement with Hanes brands will further boost our expansion plans in North America, and we are at this stage positive and excited about the opportunities that are unfolding for us in this geography. Coming now to the next segment of manufacturing. In our manufacturing segment, near full capacity utilization has resulted in top line doubling to 382 crores in the 9 months period ended FY22 as compared to last year. A rigorous focus on execution and driving higher efficiencies have translated into the loss before tax reducing by 74% in the 9 months this year versus the last year. So almost double up top line and 74% reduction in the 9 months. And in fact, in quarter 3, the losses have come down by 85% as compared to the same quarter last year. So our efforts are bringing us very close to profitability, and we are very happy to state that we are at the cusp of profitability in the manufacturing business, and we are targeting internally that we would be in both our facilities making profits in the fourth quarter. Allow me to now talk about the balance sheet and some of the key ratios. With our rigorous review mechanisms that are currently in place, along with the process improvement initiatives that have been undertaken during the quarter, I'm very happy to inform you that we have successfully achieved negative working capital of 2 days. So the power of PDS platform that we have been carefully building has enabled us come to a stage of -2 days in terms of working capital. This has been reduced from 10 days in our second quarter ended September 2021. This clubbed with our strong operating performance has enabled us to reduce our net debt from about 206 crores to about 26 crores now. This has translated into leverage ratios of net debt to equity of 0.03 and net debt to EBITDA of 0.08, and very insignificant long-term debt EBITDA. It's pretty much insignificant long-term debt, and whatever net debt we have is short-term, self-amortizing in nature in terms of our inventory and receivable realization. And as a result of the operating performance on the EBIT and profit side, as a result of the stringent control on capital employed, I'm very happy to inform you that this has translated into return on capital employed on a net basis of 38% and return on equity of about 33%. On an ending note, the last 2 years have witnessed severe disruptions across the globe. PDS has been resilient and agile to not only withstand the strong headwinds faced by the industry, but we believe we as an organization have got our act together even during this tough time and come out strong. And with our investment that we have been making, with our persuasion of strategic sourcing as a service, we are well prepared for the next phase of growth. With that, I would be very happy to answer any questions that you may have.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Apurva Bahadur from Investec India.
Hi, sir. Thank you so much for the opportunity and congratulations on a good set of numbers. Sir, you highlighted the opportunity from Haynes and S. Oliver tie-up. Would be very helpful if you could guide us as to the trajectory over the years. How do you see this opportunity panning out? What type of time lag will be there between the investment and once the revenues and the benefits start?
Yeah, hi, Apurva. I think there was noise, but I think I got the gist of your question. So let me take S. Oliver as an example. I mentioned about $50 million as the deal size. So it will take us about 3 years to get to an annualized run rate of $50 million. At this stage, we have taken charge of the operations in the month of November, December in the last quarter. And we are internally targeting that we should be doing $7 to $8 million before the end of March 22. And then scale up to a 50 million annual run rate in about 3 years. And on the Haynes deal as well, we are operationalizing. We have got a dedicated management team on ground in Bangladesh as well. And when we talk about a $400 million potential, I think it will be a gradual ramp up and it will take us about 5 years to get to an annual run rate. We'll try and do it sooner, but about 3 years to a peak run rate of 50 in S. Oliver. And about 5 years to get in Haynes. And we are operationalizing both the S. Oliver should start contributing, has already started contributing, and Haynes may take about a few months to start contributing to the top line and the bottom line of the company.
Sure, sounds very helpful. So second question is, and please pardon my ignorance on this one, but I assume that the new business expenditure which we are incurring is not a part of gross margin, right?
I think allow me to answer in this manner that typically when you start a new venture, you actually incur an infrastructure expense and admin expense which is below the gross margin. Then you also have people alongside employee expense, and then you have the initial proof of concept of sales. So to that extent, you are selling wherein you're not recovering to the extent of the full price realization that you would do. So therefore, to answer to your question is to a large extent the investment is below the gross margin, but to some extent in the initial incubation phase of a 0 to 18 months as we get to the full potential, there would be an impact on the gross margin as well. It's a natural learning curve. Yeah.
Okay, so which is why I believe that there was a slight reduction in our gross margin year on year.
I think that is one reason. The second also is that we've been having last year a portion of PPE in our income as well, because as the retail sector got hit last year, we looked for this additional opportunity working with our customers, and that has been a relatively high gross margin item. And this year the PPE has been zero as well. So that's also another reason. Yeah.
Okay, fair enough. So one bookkeeping question, and I think this is on the minority interest side. I think there has been a meaningful reduction over there. I think it has almost half, right? Despite significant increase in profitability which we are seeing. So what could be the reason behind this?
If I'm getting your question right, there is a reduction in the minority interest share because in our manufacturing operations, progress wherein the losses are more, is 100% owned by PDS, and our other factory, Green, is 75% owned by PDS. So in your consolidated profits, if minority interest partner share is not there in one, then therefore to that extent, when the losses are coming down, then the minority share portion in terms of proportionate percentage, keep going lower. That is one reason. Second is that as part of our optimization of the third segment, which is the venture tech and others, wherein we are trying to optimize the capital employed, we sold off one of the real estate properties in London and realized close to about $5 million of profit. That is, of course, 100% owned. There's no minority interest participation in that. So higher portion of income coming in, from a sale, therefore lesser minority interest, and of course reduction in losses which were hitherto, absorbed largely by PDS. These are the two reasons that come to my mind in terms of, the question that you asked.
Okay, and sir, in this gain from the sale of real estate is part of other income or a part of revenue itself this quarter?
No, it's part of the other income, and it happened in quarter one.
Okay, fair enough. Got it, sir. So one last question, if I may. This is on the maths behind the stock appreciation, right? So if I'm getting this right, sir, as the stock price increases, I think PDS will have to provide on this. So what is the conversion ratio? How much, say, for every percentage or a unit of increase in PDS's share price will be the provisioning required?
I think all the results that we report are after fully capturing the ESOP cost. I think there is a Black-Scholes formula in accounting which always captures the movement between the grant price and the price that has got achieved on the period closing for which the financials are getting reported. So therefore, whatever results that you are seeing for the quarter, for the 9 months, and going forward as well, the full ESOP impact will be part of the employee expense.
Sure, sir. Very useful. Thank you so much.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Rikin Gopani from Capri Global Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. At the outset, I would like to congratulate the team for the great results that you've reported right from the P&L, and also a great outcome on the balance sheet with the negative working capital. Now, coming to the questions that I had, firstly, if you could give some color on this contract that you're sort of discussing with Haynes. In terms of I'm just trying to understand the overall global landscape in terms of, whom was Haynes earlier dealing with for the exclusive Bangladesh relationship, and what are the factors which are now driving large players like Haynes to now sort of start working with PDS, and therefore what does it mean in terms of opportunity for us? If you could first take us through some color on that.
Yeah, I think it's a good question. So, as I mentioned as part of the opening remarks, that the one trend that is emerging is that our retail customers are choosing to focus more on the front-end activity in terms of engagement, in terms of direct engagement with the retail customers, in terms of the loyalty programs or the technology interface in terms of selling to the customers, the visual merchandise at the store level. This has been, if you permit me, relatively speaking, a back-end activity. So therefore, strategically, they are choosing to focus on core and front-end activity. That has led to they being open about it. Now, when you are letting go your back-end sourcing, you would look for a credible counterparty, who can actually take care of it. Price is important, quality is important, but the compliance is equally important as well. The financial stability is important. The global reach is important. I think PDS has been brick by brick kind of preparing itself in a form and manner, it can actually present that yes, I am, there to meet and take care of all these requisite parameters. And who has been hitherto doing it? It is the customer himself who have had a team, in-house sitting in the headquarters and also in-house sitting at the destination from where they have been sourcing, and therefore, they are, permit me to speak on their behalf that, for example, S. Oliver, I mentioned about that they had their associate company in India, which we've taken over, at a small consideration. So in a way, they had people who have had the expertise. I took them over, and that is how now they'll be working for me as part of PDS. Similar is the arrangement in Haynes, that whereby I am setting up, of course, when we are taking people on board to service Haynes, we are doing it in full consultation with them, in terms of their requirement, providing full transparency to our customer as well. So this is answering the initial 2 or 3 points that you raised. In terms of prospect, I think it's a trend that we felt is emerging, and as of now we have converted 2 of the potential into real opportunities for us, real deals for us, and we are of course also carefully evaluating at our end that as we plan for next 3-4 years, strategic sourcing should be how much part of our top line. There is enough opportunity that is emerging. And so that we will carefully take it ahead with the credibility of the customer. Is very important. As you know, PDS has been operating itself in a very manner of managing its risks. So if I have to give a ballpark answer to your question at this stage, 3-4 years from now, 20-25% of the top line of the company on a consolidated basis coming in from strategic sourcing. That's a first-class response that I'm providing to you. We are carefully internally evaluating. But that's my kind of reflection on the points that you asked.
Understood. Just a little bit of follow-up on this from the comments that you've made. So, given that this is a relationship which Haynes is now for the first time from sourcing themselves to bringing it on board with PDS, how long has the discussion been in the pipeline, and what are the key deliverables here in terms of could there be any sort of risks, or are we well mitigated in terms of the risk profile in such contracts? And does strategic sourcing offer similar return ratios at the aggregate for you, similar to what you would make in the smaller contracts? You could broadly help us understand that.
Yeah, I think such arrangements typically go 6-9 months from the initial concept stage to actually they becoming a reality, anywhere between 6 to 9 months. And there is an extensive diligence process that is underlying, which is performed by the customer on us as a counterparty. For some of the aspects that I mentioned, in terms of the capability for us to deliver, extensively assessed by the customer. And I think the risks, I would say, is first and foremost, I think when we are initiating a dialogue, we have to answer to ourselves about the creditworthiness of the customer with whom we are engaging. The way we have been very cautious about our working capital. So that is risk number one. Now, second is our own execution capabilities. If I am becoming an exclusive partner for India and Sri Lanka, for S. Oliver and for Bangladesh, for Haynes, do I have the wherewithal and knowledge base of these markets? Do I have the partner factory network on board? And then do I have my own presence of the on-ground teams? While of course there will be incremental spend I will do dedicated to a sourcing deal, but there is a large franchise I already have. Can I leverage the knowledge base and reach of that franchise as well? So I think this is answering the first part of your question. On the second part, in fact, we are evaluating, facilitating our stakeholders, in terms of getting a better visibility in terms of reporting as this business scales up, in terms of this is like a throughput, that higher output you're generating from a given franchise. So when I think the yardstick that are coming to mind are twofold. Firstly, how much profit I'm generating. When I say profit, it is the net profit I'm generating from a transaction leveraging the existing network that I have. Second, and most importantly, what is the return on capital employed, that I am generating from this business? That's the power of the platform. Sourcing as a service means you've actually got a platform of onboarding a customer, and a platform is successful. It's successfully judged through its working capital management. So that's the answer to your question, that am I further augmenting my ROC when I am doing business with these customers, and then the profitability.
Understood, sir. That is very great. Full to hear. And just on one more point which you alluded to during your comments regarding the manufacturing business, which you do expect to now start becoming profitable going forward. If you could help us get some view on this. One is obviously utilization is improving, as you said, but as a trend we are seeing that the domestic garment players basically have started seeing improving prospects and demand is great. So what are your thoughts on the domestic manufacturing capacity, and whether there is with the improvement in profitability, do you see yourself putting up further capex in this particular area? And what kind of profitability can you expect in the medium term share?
So if I'm hearing you, there are three different points that you have mentioned here. So allow me to first answer for our own manufacturing. I think a better capacity utilization in terms of strong order book, and now we would be, of course, going deeper into the order book that we are going to take, which allows me to improve my EPM earnings per minute and allow me to enhance my efficiency levels so that I can get better profitability. So operational rigor of execution coupled with the capacity filled up has allowed us to come into a situation wherein we are now sensing profits in the fourth quarter. And going forward, I think larger run orders, and careful selection of orders, and it's back to basics. It's like more operational throughput, more efficiency level improvement. So therefore, answer your question, in the near term, allow us to cross a 3% PBT to sales ratio, say over the next 1 year or so, and then thereafter, in the next 1 year, allow us to get to 5% PBT to sales ratio from the manufacturing business. That's what we are internally aspiring for. I think PDS is always open whenever there are opportunities around, to look at manufacturing, but our core is a platform, our core is an asset-light model, and so therefore we would primarily, to answer the question, be inclined to continue the sourcing as our main deployment of capital and resources as we take our business ahead. At the same time, we'll have our eyes and ears open if there are some interesting, opportunities that come our way, into looking at the manufacturing assets. But there are no concrete plans per se for now. I think on your first point, I think China plus one plus the package of incentives that the government of India has very kindly put together has made the domestic, manufacturing very attractive. And so to that extent, when I am signing an S. Oliver deal with exclusive sourcing from India and Sri Lanka, so as a sourcing company, I am well placed, to make the most of it. So that's the immediate benefit that we wish to get from India's attractiveness. But on a larger strategic front, on a 2-3 year horizon, I think I covered about reinvesting for now into newer geographical locations, new category additions, than actually into capacities. We had to get our act together to turn around the manufacturing. Now we have eyes and ears open to evaluate if any further, this cannot be and will not be a significant part of what we do. It's going to be a smaller part of what we do.
Understood, sir. That is quite useful. Thank you for elaborating on all the aspects. Thank you so much. I have done with my questions.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. The next question from the line of Apurva Bahadur from Investec India. Please go ahead.
So thank you for the opportunity again. Just wanted to know if there's any guidance from you on, say, FY22 or 23 numbers. What are we aiming for in terms of top line and bottom line, and how do we see to close this year, and then what's the target for next year? Very helpful.
I think we had witnessed for this year, for example, a 12 to 15% growth rate, and we've been fortunate to have achieved 35% plus. I think the COVID is around there still, and the variants keep coming. So as a result, we are cautious. We expect the next year also to be a growth year. And with our order book in hand, we expect the current momentum to continue in Q4 as well. But to specifically answer your question, I think 12 to 15% is what we are still maintaining for next year as well. I guess you and I need to have COVID totally behind us. Then we can actually, talk with much more confidence on a higher number. But for now, we need to be cautious, And on the other part of profitability, I think as we grow, even at 12-15%, we got to now focus on deriving operating leverage. We have an existing franchise of cost. We got to get more throughput out, and manufacturing has turned around, but it should start now contributing profits. So I think from where we are at 3.6% in the Q3 and 3.4%, PAT margin in 9 months, I guess minimum we should aim for is 40 to 50 basis point improvement on the net margin in the next year. That's what I would say is where we are when we look into the next year.
Sure, sir. Thank you very much. All the best.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Amit Choudhary from World Foods LLP. Please go ahead.
And South of America.
May I request you to repeat your question from the beginning, please? We are not able to hear you.
Can you hear me better?
Yes.
So can you explain the opportunity in South of America and the Pacific region? Is the model similar? Can this become global in the next 3-4 years?
So I would, at this stage, I think our focus is not on South America. Our focus is more on North America, as a market in the US and Canada. Primarily US is where we are, focused in terms of front end. But we do have South America in our radar, because when you are catering to a US customer, then the US customer is not just procuring from Vietnam, India or Bangladesh as locations. It also carefully, has been and carefully evaluating Middle East as well as the near geographies in South America for sourcing as well. So PDS has been evaluating expanding its factory partnership footprint, to South America as well. So to that extent, answering your question, catering to customers in North America and expanding my manufacturer's footprint to South America is the relevance of South America in another scheme of things.
And with our sourcing getting stronger, would there be a chance of building our own brand in few high margin products, or we would just stay as a sourcing partner?
We would largely stay as a sourcing partner, but at the same time, 2 things to add here. Our own retail customers, are working on their, what do you call it, a private label or brands, wherein they want that X percentage of their sales from their stores should come in from these. And they are, we are supporting them in that effort. And we are once again careful of our capital employed here. So we're trying to work on pre-sold basis. Plus our customers are encouraging us that we can actually go beyond just one retail chain and go to second or third as well, to try and sell. So that is one pursuit of developing brands, and then of course in our D2C digital, digitally driven brands is also another initiative working together with the customer That is first part. Second is we did do a small acquisition of Lily and Sid, run out of UK in terms of sustainable brand for kids, and that is a good brand that has got good traction, and we have tried to bring that brand into India as well, using the Reliance AGO platform. So to that extent, if there are such niche opportunities, we would be very open to that. But net both first and second put together, I think it will continue to be a single-digit percentage of our top line.
All right. And could you share the number of clients that increased in North America? You shared the volume and the percentage. What are the net number of clients that we brought on board?
So I can come back to you with the exact number, but what I can tell you, for example, as an immediate answer of the larger clients, for example, Kohl's is an important customer that we have brought on board. And then we have signed up with TJ Maxx, as an important customer for us as well. They are increasing presence with Walmart. One of my business heads that I brought on board as part of my new verticals is focused on that as well. Macy's is another customer that we have brought on board. So Hanes, of course, we have mentioned about. Target is another customer. So Target, TJ Maxx, Kohl's, Macy's, Hanes, and then further strengthening relationship with Walmart. So we are not looking at thinly spreading, honestly, across too many customers. We would rather be important to our large customers. But I haven't very specifically answered your question. I think I don't have the number handy, which we can surely make it available to you. But that's largely the answer in terms of larger brands than actually, kind of thinly spread across too many customers.
All right. And you must have answered this before. So were these guys sourcing on their own? They had their purchase managers, or were they sourcing from another company and they are moving to us now?
So something like Hanes, which I mentioned, is a US customer, wherein they had their own teams that were doing the sourcing activity. And the sourcing contract we have signed, now we are taking over that responsibility. So to that extent, answering your question, it is moving from an in-house sourcing to we as a third party performing the sourcing activity for them. Secondly, I think it's a mix of both, wherein the customers are growing. So as a result, we are participating in their growth. Second is, as the customer is becoming increasingly more and more, vigilant, careful about the entire aspects of sustainability, compliance, financial stability of the counterparty, having a global supply chain reach. That is where, I think the customer is getting motivated to shift from the companies which are relatively not ranking on these aspects to somebody like PDS, who very humbly is scoring well. So it's a mix of, we don't do a price game, honestly, that our strategy is not try and get a foot in the door on terms of price. I think it is more in terms of the service and the gamut of service and the strength that we bring on board. That is how we try and win the business rather than winning the business on price.
And one
that is important, but not the deciding factor. Sorry, go ahead, please.
Sorry, no. On the as an investor, the daily volumes are quite few on the BSE NSE. So, is there a possibility for some stock split or some bonus? So, just buying and selling kind of eases out for retail investors?
I think at this stage, for the last few quarters, it has been a sincere endeavor to try and improve our communication with the investors through our investor presentations and our investor calls, take your feedback in terms of the data needs, and try and come back in our next release with deeper and wider reporting. So I think we humbly believe this engagement should lead to more investor interest. Some of the reputed research houses like Edelweiss, Investec have also written management visit notes, so that I think should also facilitate the understanding of our existing and prospective stakeholders. Regarding any possible split or etc., I hear you. I think I take it as a welcome input. We will internally evaluate we haven't been working on any such thing. But through these interactions, I am also looking forward to some valuable inputs that I can take back home. So I hear you loud and clear. Yeah.
All right. Thank you. Thank you.
Thank you. The next question is from the line of Apurva Sharma from PGIM India Mutual Fund. Please go ahead.
Yeah. Thank you for the opportunity and congrats for the good set of numbers. Sir, I just wanted to understand in terms of manufacturing, since we have stabilized the operations at our own manufacturing plants, right? So going forward, since we are looking at newer geographies or deepening into newer geographies, would that entail manufacturing facilities, our own manufacturing facilities in the future, maybe in the medium term, or again, we still intend to follow asset-light approach?
So I think in the very immediate future, we've got to stay focused on getting a manufacturing to the desired level of profitability. That is number one. Secondly, with the global span or geographical coverage, with success, in realizing North America, US, we also started evaluating beyond our existing presence. In fact, there was an earlier question asked about South America and Middle East as well. Yes. In terms of the proximity of location plus any generalized system of preferences that exist. So that is also in our radar as well. So now allow me to answer with a backdrop specifically your question. Now the choices are that I continue with my existing model of partnerships and remain asset light, and or otherwise I look at some exciting opportunity, of buy to build, buy to scale up. So I would say, to answer the question, we would be largely oriented towards, sourcing and remaining asset light. But in the medium term, I think I don't rule out that we will carefully keep evaluating, and I'm not ruling it out that we do a part allocation. Of course, we have stated policy of dividend distribution to our shareholders. We are very wary of our balance sheet. So keeping all these aspects into mind, we would evaluate that if we need to do some part of the cash generation into manufacturing assets as well. But I'm telling you the guiding principles basis which we will arrive at the decision.
Sure. Thanks for that. Thank you.
Thank you. The next question is from the line of Taran from Wolbridge Capital Management. Please go ahead.
Hello, sir. Good evening. 3 questions from my side. One, sir, typically in your manufacturing business, what are the fixed costs that are associated, maybe for the year or on a quarter basis?
So I can answer on a percentage basis,
Yes.
Typically, from a good manufacturing setup, one can expect average around 35% gross margins, and then any exceptional cost, for example, if there is any freight incurrence, etc., is netted off, so we arrive at 35. And any good run facility, may actually very good run, we come to 7 to 10% PBT margin. So therefore, in between is 25 to 28 is the cost of operations, and this is typically broken up across manpower, which is a large chunk of the cost. The fact that we do value manufacturing, so there is a good component. Then of course the administrative cost of running a factory, the utility cost of running a factory, and then in the journey of ramping up activity, you do land up incurring overtimes, and if there are any delays, there is an incurrence of freight element as well. So in the efficiency journey, that's where you draw more profitability. When you improve efficiency, when you improve assembly, when you improve EMVs, then you actually EPM, that's where you start bringing your overhead cost down. And if I have to answer your question further, on an average, typically, the number varies, but 12 to 15% of the sales could be employee cost, and in terms of the ratios, and then the remaining could be other costs that I just mentioned to you.
Okay. And as you, scout for an engagement, generally, who are your peers who probably scout for a similar engagement which your client chooses from?
So the kind of model we are running, a lot of humility, it's a unique model, so as a result, we compete, as I answered to some other question earlier, we at times compete with the own sourcing teams of the customer as well. So I mentioned about S. Oliver as an example, wherein they didn't give me business from any other vendor. They gave me business from their own sourcing teams. Haynes is another example as well. So that's how we have been kind of winning business. Of course, my manufacturing, I have done close to about, for example, $50 million of sale in the 9 months. So if I annualize it, 62, 63. But of course, I'll try and draw $75, $80 million next year. But that will be a very small percentage, in terms of. Therefore, I don't portray my manufacturing as much to get the top line that I'm doing. So this is how we are, in terms of my strength is my partner network of factories across the geographies. For example, if it has come to fast fashion needs, I have Turkey as a location. If it comes to kids as a category, I am manufacturing in Sri Lanka. If it comes to value fashion, I have presence in Bangladesh. So when customer is looking at it, if for me as a single window, they know that I can cater to their various needs, assortment needs, because of my presence as well. Now, somebody asked a question earlier. I'm now trying to proactively think that if I have to increase my sales in North America further, North American customer is looking beyond the very obvious destinations, because of the proximity and other fiscal factors as well. So we are therefore actively trying to expand our footprint into these locations also.
Got it. And so, if I wanted to get a broad split of your revenues in terms of how much of it would be from apparels, how much of it would be from kids apparels, how much would be from, say, accessories, and how much would be from footwear. Is there a broad split that I could probably get?
Yeah, so I think at this stage, what I can answer you is that nearly about 90% plus is about from ladies, men's, and children's wear, and then essential is about 5%, and then there is others, which is home and others is about 2% or so. That's where things stands on the 9 months finished, and now this 2% that is there, I think it should increase because home and accessories we've invested. We actually won a large 15 million contract from another big retailer in UK. And therefore, we are. This is besides the two that I mentioned, and therefore we are expecting to see home, as a category gaining large traction, and accessories as a category gaining large traction as well, and slowly taking the brand agenda ahead. But I said it will be single digits. So therefore, from a 2% in the next 2-3 years, we should be able to get it to about 7 to 9% of the overall top line.
Got it. Thank you so much. That's really helpful.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Harsh Kumar from MIB Investments. Please go ahead.
Hi. So I had just one question. So if you look at your segment results, the profit before tax for the sourcing business has come down on a year-on-year basis for Q3. So any specific reason for that?
As I said, we have invested into the new verticals, and this is the accounting policy. It gets expensed off. So last year was a resource containment year because of COVID, so there were no investments. And this year, $3 million got invested in the 9 months period, and a large part of that has been into the third quarter. That's the only reason that they could be able. If you exclude it, we should have a growth.
Right. And for FY23, do we have any ballpark number on how much are we going to invest?
So I think we've started 10 plus new verticals, and we are carefully nurturing them to bring them to break-even situation. And now I'll try and answer that question with that backdrop. The full year investment this year could be $3.5 to $4 million, and I think next year as well, we would be investing up to this amount, not exceeding this amount, while we expect to generate more profits. But $3.5 to $4 million is what because we're also looking at more categories as well, to add. So therefore, to answer the question, $3.5 to $4 million this year and $3.5 to $4 million at max next year.
Right. Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Amit Chirodia from World Foods LLP. Please go ahead.
Hi, my other question was, is there seasonality in the sourcing business, or once you finish your autumn orders, there's spring orders and vice versa?
There is a seasonality typically, kind of the fourth quarter, which is primarily catering to the summer collections, typically is the best quarter. And so therefore, to the expected season, add 3-4 months, and that is how, so I would have a lead of 3-4 months in my quarterly data as compared to what the expected trends are. So therefore, to answer the question, I'm giving an example that quarter 4 typically is always the best because of it being catering to the summer collection requirements.
Got it. Thank you.
Thank you. Participants, you may press star and 1 to ask the question. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question.
It's already 7, so if you are okay, then you can try and wind up the call as well.
I now hand the conference over to Mr. Shirish Pandey.
Yeah, hi Sanjanji. I will not let you go. I have 3 questions. So the first question is on the domestic business. What we have understood that we have partnered with Reliance for Lily and Sib, and we have also done Turtle Dove London with the First Cry. Can you give us some update how this is faring? Is it up to your expectation, beyond expectation, and what kind of opportunity we can expect maybe in another, say, medium terms in about a year or so, and maybe 2 to 3 years?
So we are very cautious about it. I think we have launched it, and so I won't portray a very large potential here in terms of what we could do. We are beyond the specific things that you mentioned. We are doing business with Myntra. We are doing business with Reliance Retail. We're doing business with Aditya Birla. When it comes to my own manufacturing, and my sourcing is also doing business with Reliance Retail and Myntra as well. But specific to the 2 points you're mentioning, as I mentioned it twice earlier with respect to allocating capital employed. So we're very careful. I won't portray that this becoming any meaningful part of my overall top line going forward as well. Our geographical spread, I think in terms of larger scheme of things, in about 2-3 years, about 2-3% of sales on as-is basis, the way our business is continuing coming in from India is what we are looking at.
Okay, thank you. My second question is on the last call you did mention that we are now developing Vietnam and Mr. Fernando is on board, and also we are looking Turkey business to be developed. So in the next 2 to 3 quarters, how this business will shape up and what kind of sourcing we will try and get from these two locations?
So I think Vietnam, if you analyze individually, has been catering largely to the US market. So as therefore our sales are increasing in that market, the fact that we have invested into Vietnam as a sourcing hub, it will start gaining more traction. So therefore, in fact, somebody asked a question earlier as well that we are going beyond our existing location, and Vietnam investment was a step in direction, keeping US as a market in mind. That is number one. What was the other question that you asked? Sorry, I missed it. You asked 2 points in this one question. Yeah, Turkey. Yeah. Turkey, I think Turkey is shaping very, very well. I think with Russell coming on board in terms of fast fashion, so Turkey is getting more traction. In fact, our sourcing operations is the largest exporter of apparel from Turkey, and that's another market wherein we are engaged with a customer on strategic sourcing, as a transaction as well. So therefore, Turkey would become important from two folds. As the fast fashion business gains traction, sourcing from Turkey gains traction, and within Turkey, signing up with customers for sourcing as a service is also something that we are seriously taking ahead.
So that is helpful, but if just one follow-up, out of these 500 plus vendor what we have, how many are now located in Turkey and Vietnam?
So at present, about 7 to 8% of what we sell get procured from Turkey, and Vietnam is kind of not yet there in terms of gaining traction. It is as about 1 or 2%. So it just got started 3-4 months back. And specifically answer your point, we may have about close to 60 partner factories out of the global 500 factory network when it comes to Turkey.
Okay.
60.
Okay. My last question is on the Hannes deal. You said that within the next 2 to 3 years we should reach to about 400 million. But in the short term, I'm just asking from the modeling perspective, how much you think in next 1 quarter we can add and maybe next 1 year? Because I think we will have to develop at the back end and sourcing, and the model will take some time to get it stabilized.
So I would say next full year we should be able to do $50 million, under this arrangement with Haynes alone, and I think 50 million plus is what we achieve in Haynes, and in the S. Oliver transaction, we should be, I mentioned about 7 to 8 million this year by March, and next year we should be doing 20 million plus. So therefore, both put together 70 million plus from the sourcing deal should be achievable in the next financial year.
Okay. Wonderful. And just last one question. I think the things are very, very volatile and the inflation is taking its own speed and time to settle. But in the I'm not saying guidance, but in the near middle term, say maybe another 2 to 3 quarters, is there any lever we have and we can go to maybe about 5+% EBITDA margin, or the gross margin can inch up to maybe 17-18%?
See, from my sourcing business, if you exclude the investment I made, I'm already at 5.1% EBITDA margin in quarter 3, So I have already crossed 5%. And therefore, in the next few quarters, from a blended basis, wherein I am at 4.5% approximately right now in quarter 3, yes, I think in about 2-3 quarters, we see that potential to have a 50 basis point improvement through the combination of growth in the normal course, benefit of operating leverage on the existing cost structure, plus of course, as we draw more throughput from my factories, which are typically higher gross margin and higher EBITDA margin items. So combination of these 2-3 things, I think augur well for a potential, closer to 50 basis point improvement in next few quarters.
Yeah, thank you. On behalf of Centrum, Sanjay ji, I thank you, Ashish ji, and even Reena for helping us to organize this call. I thank all the participants for taking out your time, and I hope most of the questions got answered. With that, I will hand over to Mr. Jain for closing remarks. Over to you, sir.
Thank you, Centrum team, for helping us to organize this, and thank you to all our listeners for joining us. And I wish you all a great week ahead. And let's all hope to a people-friendly budget tomorrow. And I think, and let's all of us hope that we soon see that this pandemic is coming to an end. So please stay safe, all of you, and take care. Thank you so much.
Thank you.
Thank you very much. On behalf of Centrum Broking Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.